Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here is your weekly technical analysis of Chicago wheat and corn. I'll start with Chicago wheat. Since the late March low, we have seen the market gradually gap its way higher, though to be honest, it has not been as inspiring as the gaps would initially have suggested, with far calmer ranges than compared to the moves of late February and early March. However, the market action as we entered May has shown some interesting patterns. Since mid-March, we've seen the formation of two patterns. Firstly, a reverse head and shoulders pattern. Secondly, an ascending triangle. The ascending triangle has been constructed in between the uptrend, currently 1089, and the flattish trend line topside, currently 1149. So let's look a little bit more depth at these two patterns. So, the reverse head and shoulders pattern has a primary target X in the 1270 area, with a harder to get secondary target X1 in the 1320 area. This latter one is coincident with the March 2008 high. The ascending triangle pattern has a primary target X2 in the 1270 area and a secondary target X3 in the 1320 area. As you can see, the primary and secondary targets for each of these patterns are the same. It's not often that such things happen, but they have done here. The next thing to note, which to be honest is pretty obvious, is that targets X and X2 were reached last week on Tuesday. What we also saw on that Tuesday was an unusual key reversal up, which was also an indecisive spinning top, but with a long tail on it. Hence, as I mentioned last week, and I quote, "It very much looks like, at least for now, that prices have achieved what they needed to do on the upside, and we're now seeing a move back down to gather ammunition." The questions now are twofold. How far will the market fall, and will it possibly turn into a fully bearish move instead of just a pullback down? So there are three areas to look at for a pullback. 1. The very recent 50% Fibonacci line at 1162. 2. The upper trend line stroke neckline of the ascending triangle stroke reverse head and shoulders pattern that's currently at 1149. 3. The congestion area 1104 to 1125 that has the short stroke medium moving average just below, currently 1100. Finally, I'd also add 4. The lower trend line stroke uptrend of the ascending triangle, currently at 1089. There is actually an additional area below this, and this is the 50% Fibonacci line for 2022 at 1051, but I am reserving judgment on that for the moment. Any of the three areas could halt the move lower and turn prices back up. However, the last one being broken, the 50% Fibonacci line at 1051, could trigger the beginnings of a bearish incentive. Since last week, we've seen a drop through the 50% Fibonacci line at 1166 last Tuesday, with a counter to the counter combined key reversal down and bearish engulfing pattern on Wednesday and yesterday. Yesterday, those days, the market punched down through the upper trend line stroke neckline of the ascending triangle and reverse head and shoulders, currently at 1149. As far as the congestion area, it's 1104 to 1125, yet did not, so far, manage to close below the upper trend line stroke neckline. To me, this is seemingly indicative of a market that is already getting tired of pushing lower. Unless we see a determined attempt today to push lower, then I suspect we may slow or halt this decline, especially bearing in mind the long weekend coming up in the United States. Chicago corn. First off, please kindly continue to ignore the color change on some of my labeling. This is something my charting system occasionally does without my permission. There's no special quality attributed to the different colors. Okay. So the move up to the heights of late April can be attributed to one key action, which subsequently led to many others. The key action was the almost weekly key reversal up that happened at the end of March, but which ended up being a lesser outside week pattern instead. That week was also a spike bottom, which, along with the earlier pipe bottom in mid-March, formed a double bottom, thereby causing prices to rise. The rise continued until the weekly key reversal up made 4 weeks ago, when the hubris of the market met its nemesis, at least for now. The reason for the lack of bullish action can clearly be seen, and one I've spoken about some time before. It is the middle time overhead, currently 841, of the April 2020 to September 2021 bullish Andrews pitchfork. This had been used as a rolling higher resistance back in early March and again at the end of April. The result of this, all of this, was a fall in prices down to the congestion at 789, then down to the October 2012 high at 776, then the November 2012 high at 768, then down to the February 2013 high at 714, and then down this week through the May 2021 high at 735, yesterday closing ever so slightly underneath it. We now have further support of 719 and then the rising medium moving average currently 713, and this last one is perhaps the first real support of note we will see since the break below the short medium moving average, and that's currently at 762. However, all these moves lower, I would still like to remind you of one thing. The original April 2020 to September 2021 bullish Andrews pitchfork that started the whole move higher will still be valid. Hence, nothing has changed in the picture of this longer-term bullish pattern. All we are seeing is still a pullback in an overall bullish scenario, at least for now. Now, I have to add that last part, the for now part, as we never know, but realistically we are still within the bullish scenario. The lower time for this pattern is currently down at 679, and until this is broken, and by that I mean properly broken, then this bullish pitchfork will still be valid. One other final point. Peeking out at the top of my daily chart on the right is target X. This drew back in March and is a target for the May 2021 to date action, being a rounded bottom pattern. I had highlighted this pattern back in March and it is still good. Target X is in the 890 area. It's just, well, it's an awfully long way from where we are now. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Eddie Tofpik and ADM Investors International Limited. And here comes the final bit.